Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Sweat. You ready? Let's dive in.
On this week's episode of Swimming with Allocators, you have your hosts, Alexa Benz and me, Ernest Sweat, for a special DDQ episode. This is our second one. And so to kind of level set, for those that are not fund managers, something that you will have to go through if you ever do raise any type of fund from institutional investors is you'll have to answer all of these DDQs, which are due diligence questions. And so they can be very, very long and arduous. And
it's a beast. It keeps getting longer.
Yeah, everyone we talk to, they say they keep getting longer. And so we wanted to have a kind of fun play on something that all fund managers and allocators have to deal with.
So we're calling these the DDQ episodes. D number 1, we discuss what we've been hearing from LPs. D number 2, we debate some of the things that Ernest and I have been learning, our own point of view, and then we answer some of their audience questions. So should you have any questions you want us to answer on the next DDQ, shoot them to us on social.
So first, discuss. These are themes that we're hearing from allocators, both from the episodes that you have heard, from things that maybe we heard off the record, or episodes you haven't heard yet. So Alexa, what's the first theme that you've been hearing from the allocators?
Yeah, I think a common one is that your next fund is going to primarily be made up from your existing LPs. I think for GPs in firm building mode, that's pretty rough news to hear. But I do think there are some easy ways to mitigate this. A maybe extreme example, Jason Calacanis just recorded with us. You'll hear him next week. And he described Fund 1 for him was 10 million, Fund 2 was 11. And he's out in market right now raising 100 million. And he's told us if he were to do it again or going forward, he's going to be focusing on annual rolling $10 million funds. If you are a first-time fund manager, you're getting ready to go out for Fund 2, those were probably friends, family, founders backing you. And because they're not institutional LPs, they aren't necessarily familiar with the re-up process. They may not even know that's something they have an opportunity to do or an expectation. So I think it's on you as the fund manager to be educating your less professional LPs and really embracing those smaller LPs to bring them along to Fund 2.
That kind of ties into what I've been hearing, and it's being more prepared when meeting LPs for the first time and understanding the long-term relationship path that you're going on.
Absolutely.
And so, we've heard this from a number of allocators, and not to kind of plug our show, I think one of the great things that we're offering on our platform is an opportunity for you to have that first meeting, really kind of intro meeting. We've all been there where we're meeting with founders or allocators and we're slotted for 30 minutes, but about 20 minutes is taken up by both sides doing intros. We're taking away some of that for you. And we've actually heard from fund managers, both established going on Fund 6 to those going to Fund 1 or Fund 2, how they've been able to listen to these episodes, gain insights, and then have more thoughtful conversations with those allocators. And so taking both of those sides, it's really important for you to be as prepared and understand your customer, which are the allocators, and see how you actually fit. Do they even like your style, whether it's your construction, your fund size, or are they overweight in that?
No, totally. It's like making this a two-way conversation. I've had a few managers pitch me recently that did a really good job of this, and it reminds me why C founders are so stellar at getting the gist out in, say, 5 minutes, and that leaves 25 minutes to actually have a conversation.
Yeah.
And same thing if you're pitching your fund to an LP. Of course, you've got 15 slides. Of course, you've got a data room if they want to go take a look, but that's not what the first meeting is for. The first meeting is just to get to know each other and see if you're even on the same page, if there's any alignment here.
Another thing that I have started to hear from both fund managers and allocators are that people are looking to deploy still. Now, it still might take time, but you have to be persistent. I've heard, and this, who knows, this might be stale when this comes out, but even family offices in the energy region, so Texas and Oklahoma, given kind of like where the price of oil has been, those family offices are now a little bit more active and have a little bit more capital to be able to deploy in private equity and venture capital. And so it's about being persistent and looking for where the opportunity is, because there is capital out there looking to deploy. From the international markets, I've heard of the rise of companies, whether it's corporates or family offices out of Asia, so in Japan, Korea, really looking to invest more in U.S. Venture capital. And part of that is because if you look at their economies, especially Japan, hasn't been as much innovation, and they're really trying to get both strategic insights as well as returns, but a lot of strategic insights that they can bring to their own ecosystem. And so, we've started to hear that the large funds, large asset allocators that are across multi-stage, are going more and more over there, as well as if you're emerging managers who have some relationship connection, can speak the language, you're at an advantage. So that's another point. But with that said, I think all the stuff that we're learning, I think really fuels kind of the next segment of debate. And so looking forward to sharing what I believe and seeing if Alexa feels the same way.
No, it's interesting that some of the things that we have not shared with each other what we want to debate yet. And some of them are things that we've been hearing from LPs that I slightly disagree or maybe have a hot take. Okay, hot take. We are hearing a lot of LPs who are saying for true venture returns, that's 5x to 8x, you need to go early in the life cycle. So they're focused on sub $50 million funds. Specifically, they're looking at seed, pre-seed. I've got some questions about that strategy, and I know timing the market is not advised. But right now, we're looking at a valuation reset in Series A and above, where valuations are still pretty high in seed. So if you've got limited slots for a new manager, maybe you're going to deploy into one new manager, maybe two, and you already know the 2023, 2024 vintage, you're able to look at some of the companies that they've put in the portfolio. I'm not sure why you're going to go for a pre-seed or seed-based fund when, frankly, Ernest, I'd love to hear your perspective on this because you're more of a Series A investor, growth investor. It seems like you have way lower risk and better pricing at Series A.
Yeah, I am extremely bullish on A right now, and I hate this because we agree. But yeah, and I've heard, I've seen as well as talked to some other fellow Series A investors, and you're starting to see just a variety of points on like our opinions on what Series A metrics should be.
Yeah.
And so that's causing the same problems we saw in Series B and Series C a year ago on like, what is a Series B? What is a Series C pricing? Because we were out of whack the last couple of years. You're seeing that in Series A. So like for this is throwing out even the AI companies that they're just going to price at whatever they price at. But everything else, where you're having good growth, good companies, everybody's like, yeah, get to 1 million ARR. Is that actually the right number? And is it really about, do you have the ability to create a sustainable, enduring business that can grow faster when the market's right? And so, yeah, I think the pricing is going to be very interesting right now, especially if you raised a seed um, in the kind of height of the market,
Yeah.
2021, 2022. So yeah, I'm extremely bullish on Series A.
Okay, so if you are a pre-seed or seed fund, maybe what you need to go do is a tiny little opportunity fund. Like maybe that's the thing to be raising right now.
No, I disagree with that. I think we've
I'm
learned
glad we have
from
something we disagree with. This is more
yeah.
fun.
Yeah, exactly. Thank you for saying something wrong, Alexa. So it's I completely disagree right now. I think if we look at the ZERP era, where we had what we had there was like obviously cheap capital, but we also had a lot of new managers as well as established managers have scope creep, right? And as I've talked to allocators more and more over these last couple of years, I can see their point of like, hey, I am making a big bet and risk,
Yeah.
especially if I'm an institutional fund, on you, Ernest, you, Alexa, to do what you told me you were going to do. To then think when you come back and you're actually doing well at what you told me you would do, and then say, but yeah, actually, I want to do all this other stuff. It, that means I have to diligence something totally new
Yeah,
and
for
question
sure.
all these other things. And so I would say, kind of like a way to meet in the middle is as you have great companies that you've invested in, or even I've always argued, even companies that maybe you tried to get in but missed. If you have the ability and some strong LPs that are willing to do co-investments with you, that's
Hmm.
way for you to like maintain ownership or even increase your ownership or make brand new investments. That's kind of like a middle ground instead of doing an opportunity fund.
Yeah. No, and I would argue that somebody who does A consistently, like yourself, knows what you're up against versus if you're a pre-seed and seed investor, you don't see hundreds of decks of other A rounds. So I truly would trust Series A guys to pick among the winners more than the insiders.
It's funny you brought kind of like where the opportunity is. You were looking at from a in kind of fund manager perspective. I came up with one of my debate topics was actually from the allocator perspective. Where is the opportunity? Is it we're seeing this bifurcation of cottage industry,
Mm-hmm.
and from talking to Frank from Morgan Creek about the keynotes that kind of solo capitalists, those connectors, and it becoming a kind of two offerings right now, right? Like it's either you're an asset allocator, really, really big, you're offering capital, or you're one of these kind of cottage industry, kind of going back to the old
Mm-hmm.
days, and you're offering relationships and kind of one-on-one help.
Yeah.
And so, you know, anytime I go on Twitter, VC Twitter, or VC LinkedIn, you see different views on or data on which actually performs better.
Mm-hmm.
I'm on the personal and biased view that like funds that are 500 and below or can perform a lot better. It's just kind of like a math thing. Um, but where is the actual opportunity? I think in this next stage, it's going to be the smaller companies. But you know, when I also think about kind of where this market is going, I
Yeah.
think about even the advances of like if AI is the biggest driver, what's a better bet? One of the top five cloud providers stocks or a new startup? Like what's going to like, or I'll give you the field of startups
Yeah.
versus those five companies. Like who's going to perform better over the next 10 years?
For sure. No, I mean, I just bought a bunch of Microsoft for sure. Okay, well, let's play a game. Let's play a game here of like who the better bet is. I'm gonna throw out 3 theoretical emerging managers, and we're gonna play FMK. That's for those who aren't familiar. That's
flirt is flirt.
Exactly.
Marry,
exactly. Bang, marry, kill. I'm gonna describe 3 pitches, three managers, and who's your long-term bet? Who's good for fun 1? Oh yeah, just a fun 1. And who do you pass entirely? Okay. Do you like this game?
Okay.
You
Yeah.
ready?
You could also do it in a sports thing. You could have did start, bench, or cut. But yes.
I mean, all right, folks. Start, bench, or cut. Option number 1. You get a pitch from founder turned angel. This is first check-in strategy, all in the industry he knows, highly engaged in 20 deals, and the LPs are all fellow founder friends.
Okay.
Or pitch number 2 is a new Substack newsletter publisher. It's all AI, huge social following, extremely young, maybe minimal work experience, but technical, and tons of deal flow, and the LPs are the readers.
First of all, I feel like you're trolling, and it's hard for me not to spew out names of people I know and some people I don't know. But yeah, continue. All right, gotcha.
Pitch number 3, a principal from a brand name VC going out on his own, infrastructure focus, LPs are the old boss.
Make it a junior partner instead. But
why
go ahead.
Are you? Yeah. No, why are you stepping on my shit? This is the choices. These are
okay.
it.
All right. Cool.
We're playing FMK, and these are your options.
All right. Cool. All right. Cool. Go. Finish the third one then. Finish the third one.
It's a principal. This is an adult, brand name VC going out on his own, and the LPs are the old boss, and a few relationships, a few LPs from the old firm.
Okay. Some clarifying questions. Are they all raising the same size fund?
Today, they are all raising the same size fund. So the question might be, who has potential down the road? But yes, today they're all raising, let's say, 20.
Okay. And all pre-seed seed, obviously. All right. So the first person, founder, archetype. Second person is kind of like this social community archetype. And third is like the investor type who probably couldn't get deals done at their firm. And then, all right, so I'm doing start, bench, and cut. So also, okay, before I give my answers, this is an awesome game and we should do this all the time. Second, this also shows why this industry in fundraising is tough, because there's no standard answer. Each of these, all the permutations of these 3 can be for different people, and that's why it's important to find the right people and understand your ICP. So totally. I would
there's 100 of each of these.
Yeah. But then also understanding kind of like, if I'm the LP, like I'm the ICP for a very, like, it's probably pretty easy to see who I'm going to like connect with first or value more or all that stuff, but just on my experience and what I've seen, my interest. So I would probably do at the early stage, it'll probably be the founder first.
Is your bench?
No, start the
founder.
Start the founder, because my thinking behind that is she will have the relationships, know exactly, after all the people who've worked for her, who she's partnered with, and great founders. Depending on like, I would have to dig into like what is their, have they made an exit, have they gotten close to exit, all that stuff. They usually know other great founders, and so betting on that.
Mm-hmm.
The second person, because it's also my bias as a Series A investor, is like, all right, much earlier than me is much, much more towards diligencing people and seeing opportunities. And so I'm going to value that more. So digging into the second person, the bench would probably be my community person, because based on kind of what they've been able, like how much reach have they had, who's been involved, I think I would really value that to be able to get deal flow as a Series A investor.
Yeah.
And then cutting would probably be somebody who's more my archetype, similar, right? We have more overlap. And that's the principle coming from the brand name firm, because the question always there, rightfully or wrongfully, is did they get the deals, or did their email address get the deals?
Mm-hmm.
And that's a hard thing to say, but it's real. So I would want to dig into what angel things are done. I want to dig into, like, it's great to have support from your former bosses as well. But were they doing Series A and now they're doing C? That might be a leap. But we've seen, and I'm not going to give people shout outs that I don't know, but like we've seen people do it and do it well. Yeah. And so there's no shot at them. It's just like what I would want when I'm investing, especially somebody who's already an investor, I want people to fill gaps that I don't have.
Yeah.
What would be your answer?
I think I start the founder too, because they actually have run a business. And I think this is more than just sourcing and selecting. I think like day one, if you're taking money, you're starting a company. So I think they're going to be better at processes. I think they're going to be better at understanding differentiation, etc. If I could pair them,
how did you say I can't change your rules, but then like you're changing rules? Man.
I think it's a bigger toss up for me between 2 and 3. Do I cut the community or the lifetime investor? But truth be told, if you only get to cut one check, it's going to founder. Yeah.
Yeah. And so to kind of close out, you kind of brought up with that last archetype, the spin out of the principal, or I even think, junior partner or GPs. I wanted to throw out a statement that I think VCs customer bases should really think about more. And so those customers are obviously like LPs and founders. But my hot take is, I think the biggest flight risk in our industry right now are 30-something and 40-something GPs.
Where are they going, Ernest?
I will repeat. I think the biggest flight risk are 30-somethings and 40-somethings GPs at funds. I think that, I've had friends who were at Upfront. I've had friends who've just, been talking to them, and even people you think that are sitting pretty at their firms. And I won't give details of firms because it's so easy to just like guess who the people are, but that are waiting for the moment that there's a better market to either jump ship to another firm or team up with friends. And so
100%.
I think it's something that's not really talked about, but I've actually heard, and I want to hear your opinion on it too. I've heard that founders have started asking these people in these archetypes, hey, I like you, but this is, if you're a seed investor or a Series A investor or even Series B investor, we're looking at anywhere from 7 to 12 years, right, of a relationship. If I take this check from you, will you still be here in 2 years?
Yeah.
Because I like you. Question. I like you.
Yeah.
But I don't really like anybody else at this firm.
Yeah. So 100%. Yeah. People are asking me for advice on fundraising. Who are those people right now? Who, yeah, you would assume that they are quite happy working for some gray hairs, and in fact, they're more excited about going and doing their own fund.
Yeah. So
Okay.
my advice would be, I think if you are an allocator or a founder, you should really be asking you should be asking these people. You should be asking, potential partners, VCs, you know, what are you looking to be here for a while? Like, I would love
It's a
to
great
develop a
question.
relationship with you, or really diligence the entire firm so that, like, if somebody does move for a better opportunity or new opportunity or whatever, you feel comfortable that you've established a relationship with all those people.
No, I think that's great advice to check in with everybody on how long they're planning on sticking around.
Yeah.
Interesting. Okay, I've got one final hot take.
Oh, I don't think you put this on here, but okay, cool. It's not on the
Uh,
rundown, everybody.
Final hot take. We're hearing from folks. Okay, Josh Wolf quote on Twitter: "Massive, massive contraction in VC coming." And my hot take is that this is not an emerging manager reset or even a VC reset. I think this is a blip, and that we should expect to see emerging managers, first time funds continue to explode up into the right over time. I think my context for this is at the dawn of the micro VC era. Um, my sisters and I invested in Mike Rothenberg's first fund. It was 5 million, fund one, and his pitch was, "I'm 29. I'm going to invest in my own friends." What's crazy is that like that was a unique strategy at the time. And right now, everybody who's a first-time fund manager is 29 and investing in their friends. um, it's become so much easier to get a fund up and running in those past 10 years. And a lot of that is thanks to the tech platforms that are our sponsors, and they're making up setting up and managing a fund super easy. But I think what that means is, I'm not kidding, we're going to have tons of high schoolers starting VC funds. Everybody and their moms and their moms and their grandmas and their babies are going to be starting VC funds as time goes on. I don't think this is a new trend. And with that, I think the business model might change. So you'll have some GPs, yes, who are firm builders, going for, growing assets under management, going for management fees. But I think others are going to be opportunistic and time bound. So you can imagine 2 second years at GSB, they get together a $15 million fund from their network to invest in their classmates, and with the intention that they're going to deploy over 24 months, and then they can hand things over to like a parachute or an Envoy Capital to manage the thing for the final 8 years. So like this question of there's a lot of focus right now on graduation rates, and I think like that's kind of missing the point, that some of these managers potentially don't want a 10-year commitment. They're not looking for a marriage. And I think actually LPs are going to start to appreciate, I mean, I would probably go in on that. Today I am not announcing my fund of high school VCs, but stay tuned. Maybe that's next week.
That's funny. That sounds awful to me, like I said. but I'm also becoming I'm a middle-aged man now. I think you're probably right. I'm not sure if there's a market for that. Maybe as we have more democratization of kind of venture and access to it, and have more retail investors, we're starting to see a lot more RIA plays, right? And I think we have some that are some of those more established programs going to be guests in this season. So that's exciting. But I do still, for the like level up, if we look at the LP stack, as you get higher and higher up, those individuals are still going to be looking for not investors, because I think what you're talking about is we'll have like a proliferation of investors, but they're going to be looking for fund managers. And so the question is like, do you want to be a fund manager, which is a very different thing. So I think that'll probably happen, and we'll start to see kind of like even bigger asset allocators and multi-stage funds, and then more of this kind of like, what does that do to seed? And this sounds like Series A is just going to be awesome because that's going to be the first institutional investing group or majority in institutional investing group. So maybe I do like it. Actually, I changed my mind.
I don't think it's great for the retail investors. I think you still have power law, and I think it'll be really hard as a person dabbling in your son's senior year VC fund. So I don't know that the returns will be there, but I think the kids are going to try it. And by kids, I mean all of us. I mean everybody who's starting a VC fund. You don't set out to be a bottom 90% fund, right?
So actually, to that point where that this all originated, your point from the tweet, and actually, what I kind of heard from that tweet, listening when you were saying it, was that the contraction, I think, is going to come from all aspects, right? It's not just the graduation, like you mentioned, of emerging managers. We're going to see a lot of those that are between Fund 4 and Fund 8 that are going to stop.
Yeah.
And we've already talked about like a lot of those firms who have decided not to raise another fund. But even, talking to large fund of funds that have been around for a while, talking about, do they still want to be in the business of like the asset allocators and multi-stage? And so this is why you're starting to see those bigger players that we all know the names are going to more international potential LPs, as well as like going to places that they never went to, even in the country, to ask for money. So everybody's feeling it from all aspects of the industry. Now we'll start answering a few questions that we have that we gather from our listeners. As a reminder, if you have any questions for us, you don't have to wait until we ask too late on on our social media right before. You can always just say, you can find us on LinkedIn or Twitter and just say, hey, here's some questions that I think I would love to hear you two perspective on. So Alexa, you want to start us off?
Okay, so from Sure Ventures Gopi, he's asking, of the three S's, sourcing, selection, and support, what matters most? And I think we could put a little earnest spin on this and say specifically with the entree of AI in venture, as when you add in the co-pilot in this job, does that affect what's most important between sourcing, selection, and support?
That's a great question. I think it's always going to come down to selection. Like, obviously, if you don't have the sourcing capabilities, then yeah, you're dead on arrival. But let's say you do get that. That's only part of the battle. You can find all the great deals and have the best anti-portfolio, but that's not going to bring in more allocators to invest in your funds or make you intriguing. When people think about what's the secret sauce of an individual, they're really asking, how do you select from the pools of sourcing that you have? And so this is probably, when you're thinking about starting a fund, I would say thinking about what is unique about your selection strategy. So I think it can help fill the gaps on different things, right? It can help you draft, diligence memos at a faster pace. You can even create certain things to be able to then source and use, AI, as well as with kind of like a lot of these data sources on like, hey, these are the type of companies that fit my thesis best. So it can help with like timing and kind of like a lot of the grunt work that a computer can do a lot better. But when it comes to actually assessing talent, we still have to go back to real intelligence. I think that's in every industry. Like, you still there's certain things humans can do still in assessing things and getting a feel for things and having that commitment and conviction. These are not things that AI can do. yet. Not to scare people, but like, yeah. So that's my view. It's a tool to be able to kind of like cover your bases, but it's still going to come down to like you selecting the right company, you sourcing from the right pools, and essentially like, yeah, all it still needs you to provide a prompt. All right. So our next question was from a first-time fund manager, and their situation is they've closed $10 million. Were originally going for more, and their question is, should they just close and then go back to the market later when the market's better for $25 million for a bigger fund to appeal to more institutions? So it's kind of this idea of like, get what you can now, prove it out, and then go back to those that you were in discussion with.
Yeah. Yeah, we've had a couple LPs on the show talk about your minimum viable fund. So maybe you just figure that out. Can you pay for your mortgage? Is this enough? But I don't know why. Something about this question bores me to death. I just don't even care what you decide. Like, I give 0 Fs what you do.
I did not see that coming. Okay, so somebody's going to be the bad cop. I'll be a good cop. I think you should. I think you should consider, your situation. Is it first close, second close? What are you trying? It's kind of like when you talk to a founder and they're like, I'm going to raise a 300K bridge. And it's like, for what are we bridging towards?
Is the story going to be that different?
Good call. It going to be that different? And so really kind of ask those questions of what are you trying to get to? What narrative are you trying to say? And then, if you do just stop now, first of all, and this is hard for me to do, I'm like the worst at it, but like, be grateful and celebrate that you were able to, you got 10 more million than a lot of people, and go to work, make the best like investments that you can, and then have a story on like how you're going to grow and why you're going to grow for this next fund. Again, it's about, are you an investor or a fund manager? If you're a fund manager, you're able to start from something and then grow that into something else.
Oh, good thing you have Earnest.
That's what I'm here for.
Okay, last question. OpenLP posed, what should LPs be asking GPs? And I'd like to flip that and ask, what should GPs be asking LPs?
I think they should be asking, are you deploying capital now? Because
totally.
Because one of the most frustrating things from founders we hear are like when they start to really enjoy getting to know a fund manager and then hear the fund manager hasn't closed their fund.
Yes.
And can't really deploy anything. That's frustrating. It's starting to happen more even from LPs. And so LPs, be upfront, like you tell us to be upfront with founders, you all should be upfront with fund managers. So that's one. Second, do as much research as you can, but if you can't find, I would even ask, like, what do you feel that you're underweight in or overweight in? Because that can give you a sense of if you fit or you don't fit. And if this truly is about developing relationships for the long term, maybe they're overweight in your category of Series A B2B software.
Yeah.
But they're underweight in consumer. You're like, well, I have a very good friend, Alexa, who you should meet. Starting those relationships, and then Alexa's going to blow them away. Then they're going to think more highly of you as well, right? So those are the two things I would ask.
Yeah. Yeah. Is there anything the IC committee might be hung up on, or might be, something that they might bring up? And so you can practice together addressing whatever the whatever the confounding elements of your strategy are. So you can actually talk through it with them. And maybe the answer is, oh, it's not going to be a fit, or maybe the answer is, oh, cool. Now that we've talked through it, I think that is a good argument why this is a good fit.
So one thing that happens a lot of times on DDQs is there's usually a box at the end if you've answered your life away of 50 pages of like, is there any additional information? So we wanted to have a segment called Additional Information, where one of us provides kind of some parting thoughts that may or may not have anything to do with what we've spoken about. So I'll do the first one. We'll see how this goes. And Alexa, feel free to, if you find something funny, laugh. If you don't, it's fine too. All right. I need to call something out that's really popular right now. Sure, it's having a lot of adoption, faster than PCs, cloud computing, and mobile combined. It feels like a real platform shift in our society, and I need to call out what's wrong with it before it becomes so mainstream. I mean, from teenagers to grandparents, everyone is talking about it and consuming it. And enough is enough. Even though it seems like we are headed into a world where all we see and hear and consume will be unoriginal, maybe even artificial. Oh, I just realized you might think I'm talking about AI. No, that ship has sailed. That is definitely going to be infused in every aspect of our personal and professional lives. Although I promise I didn't use ChatGPT to write any of this. This is real intelligence. Anyway, back to my point.
What is it?
I want to point out something more on the undercurrent, but it's there if you notice it. I'm talking about nostalgia. Ugh. It's at an all-time high in the 2020s. From the entertainment industry, bringing back new stories of my childhood favorites like Teenage Mutant Ninja Turtles to X-Men. Others being taken back with the Barbie movie, or new generations joining the conversation of once popular TV shows like Friends, overrated, Martin, underrated, and Seinfeld, unquestionably the greatest show of all time. Hell, I've even seen it in consumer tech with the rise of non-smartphones and wired headphones becoming more popular. Look, it's even got me. And lastly, I can't forget how even the political arena has become nostalgic and has resulted in us having the same two presidential candidates that we had long ago in the fall of 2020. But the venture capital industry hasn't been shielded from this shift. That I want the old thing back train is here. We've had very prominent investors move back to their former firms, with other founders turned investors turning back to becoming founders, as it seems the clock is striking almost midnight. We have also seen the trends of capital deployment and fundraising returning back to the good old days, or I should say, not so good old days for some. The class of ZERP emerging managers are struggling now to raise Fund 1 or Fund 2. Capital raised by underrepresented and female founders has returned back to the days of 2016 and 2017. The untold story is that so many women and Black and Latinx investors that broke into the industry as associates, principals, junior partners are now still on a website but no longer work for those firms, and fear that they might not get back into the industry. While the industry is clearly at an inflection point where there are some firms going back to being one-on-one personal relationship focused, while others are becoming bigger and bigger and bigger and providing capital as an asset allocators. So what's the point of nostalgia? To learn from the past, or reinvent it, or keep doing the same thing? Instead of making things great again in VC, let's make them better.
I love it, Ernest. I think you're hitting on something here that it does feel like a reversion to the comfortable.
Yeah.
And a reversion to how things have been.
So hopefully we can help with this platform to not and make things more transparent and make better opportunities.
My high school fund of funds is going to be the first of its kind. And we're only going forward.
Well, at least I pleased you on that, Alexa. So you're up for next DDQ.
See you later, allocator.
After portfolio tile, investing with a smile.